Hello everyone, welcome to Options Discovery on John Lothian News The Spread. My name is Asma Awas and I'll be your host throughout the series. In this episode, we'll be talking about risk management for options portfolios. I also have a chance to sit down with Hilary Till, the principal of Premia Capital Management. Hilary shares more insight into the different kinds of research she has done, as well as her experience managing large portfolios. Let's get started by talking about some of the reasons why an options trader might want to create an options portfolio. Creating a portfolio with options can provide enhanced returns for a trader. Options allow investors to leverage their positions. This can potentially amplify returns compared to simply buying or selling stocks outright. Strategies like covered calls or selling puts can generate income while holding a stock. Another reason is diversification. Including options in a portfolio can bring down the overall portfolio risk and possibly diversify away certain risks that come with buying basic securities like stocks or bonds. Including options in a portfolio also allows traders to be more flexible in their outlook. Depending on a trader's market views, risk tolerances, and investment objectives, they can choose from a variety of strategies like strangles, straddles, spreads, or collars. With all the benefits that options portfolios provide, they also require risk management on the trader's end. When traders construct a market portfolio, it's important for them to understand how beta comes into play. Beta is considered the market risk or systemic risk because it compares the risk of the security to the market as a whole. The market has a beta of 1, so stocks that have a beta that is greater than 1 are considered riskier but have a greater potential for return. Stocks that have a beta less than 1 are considered less risky, but they might produce a lower return. In general, industry sectors like tech, energy, or financials are considered more sensitive to economic conditions and might have a higher beta. Once traders understand how beta affects the underlying stock, it can help them build better option strategies. For example, a high beta stock might have large price fluctuations. In this case, a trader can implement strategies like long straddles or strangles that profit from high volatility. On the other hand, a lower beta stock might not fluctuate as much. In this case, a trader can implement strategies like covered calls or short straddles. Along with option strategy selection, beta can manage risk of the options portfolio as a whole. Incorporating assets with both positive and negative betas can help balance out an options portfolio and mitigate against losses in a downturn or fluctuating market. Understanding beta is only part of managing an options portfolio. I sat down with Hilary Till, the principal of Chicago-based Premia Capital Management, to talk more about this subject and her own experiences in the options industry. Without further ado, please enjoy this week's episode. Hello, everyone. Welcome to another episode of Options Discovery. Today, I have a chance to sit down with Hilary Till. Hilary, can you tell me a little bit more about yourself and how you got to where you are today?
Yes, certainly. And so in addition to discussing my career progression, I'll also talk about the option strategies at the various firms that I've been associated with. So just starting out, I got my bachelor's and master's degrees in statistics, although in college I took more computer science classes than statistics classes. My first job was at a predecessor firm to Accenture. I worked in their artificial intelligence group, designing expert systems for clients. I designed a car loan application decision-making system for Ford. That was actually a pretty interesting first job. I flew to Detroit every week, and I got to the point where I'd fall asleep before the plane would even take off. So next I worked at a Chicago proprietary trading firm. And they had 2 floor teams for the bond options and foreign currency options. I created all their software programming in the programming language C. This particular software created the trading sheets that showed the traders across price level, futures levels, and options, how the premiums and the deltas changed. And since I was the computer person, that meant doing everything having to do with the computer, whether it's programming the inventory and pricing software, down to the physical computer itself. So when the floor traders would, I mean, the clerks would kick it accidentally, apparently, would kick in the computers on the floor. I would need to show up carrying a personal computer. And then, taping it into the electrical outlet using as much black electrician's tape as possible. And I remember when I would go on the floor, it was just incredible. I mean, the amount of energy just emanating everywhere from the floor traders was such that the hairs in the back of my neck would stand up. So anyway, that was so I kind of took some notes to remember these experiences. So I remember when I interviewed at this Chicago proprietary trading firm. Okay, fair enough. I was given a programming test. And then while I was being verbally interviewed, the head trader was making a paper airplane out of a Federal Express box. So I thought, oh, wow, this would be great to get that job here. And I did. And then this stint was followed by working at a Chicago bank where I maintained the software for the foreign currency options traders. Whenever the marketers needed a new complex option priced for a client, I would modify the pricing software basically by adding custom payoffs in the binomial options pricing routine. And at this bank, I also worked with 3 developers in the interest rate derivatives business, where we created and maintained software, custom software for pricing and inventory for the desk swaps, caps, floors, and swaptions business. So I was sort of in the derivatives business in Chicago, but really on the quant programming side, obviously. Which makes sense. I didn't really have value-added skills when I didn't have clear-cut value-added practical skills. So my entree into the business was programming. My husband was able to get a medical residency position at Harvard, so we left Chicago for Boston, and things changed. Back in the day, downtown Chicago had an international newspaper stand. And I picked up a Sunday Boston Globe, and there was like a dozen recruiters. So I fired off my resume to a dozen recruiters, and luckily a job came through. And so I worked for Harvard's endowment, again as a quant. So I worked for the domestic and international derivatives portfolio managers, and amongst other things, I wrote the pricing software for the convertible bond options book. And then I moved from there because at long last, I wanted to be a trader. And so I took a pay cut to do so. Again, things change. I found the job perusing the job section of the Friday Wall Street Journal, which at least at the time had ads for local positions. And so I became a market maker on the bank's interest rate derivatives desk. I started becoming more aware of the business side of things. It was very instructive to watch the marketers come up with seemingly unnecessarily complex structures with clients. And just so happened that with such structures, probably coincidence, one can add more margin to the transaction since the competitive pair pricing wasn't as obvious. And Boston's business district is in a pretty small area in downtown Boston, so it wasn't that hard to interview at various jobs during one's lunch hour. There was, I don't know about now, but at the time there was apparently an informal non-compete arrangement between mutual fund companies and to not poach each other's employees. So as long as one moved to jobs that were across business types, one could still do this to advance one's career. After the Boston Bank, I went to Putnam Investments and eventually became responsible for the strategy development and execution of about $90 billion of notional of derivatives per year. I mean, this just built off of all these, derivatives experiences that I had before in Chicago and Boston. And there, I added a lot of controls to the centralized derivatives function amidst a lot of controversies at the time, because there were a lot of derivatives blowups. Various funds were reaching for yield and in a low interest rate environment. And one way of increasing yield in a low interest rate environment is to basically have some short optionality within the structure and treat that as yield. But short options and it's become volatile, it's become a pretty tricky thing. So then following Putnam, so I'd worked in a large company, and then I still really wanted to trade, and so a colleague from Putnam and I went to Chicago to start a proprietary trading firm, and we focused on empirical regularities in pockets of predictability in the commodity markets. We mainly did future spreads and futures butterfly trades. And along the way, I've done a lot of quantitative consulting, written white papers for Nubian Investments, the Managed Funds Association, the International Energy Association, the World Bank, the CME Group, Organic Valley, the organic dairy, the nationwide organic dairy co-op that's headquartered in Wisconsin. And then also I worked in the risk division of Bank of New York Mellon Wealth Management. And so that was sort of how I stayed involved in various, the world changes. And so these consulting positions allowed me to stay in the state of the art at various types of firms. In a way, it's sort of like these are all different domains, but net, there's sort of common, well, in the commodity markets, there's common frameworks for analyzing things. And then I've stayed in academia, interestingly enough. And so right now I'm an honorary senior visiting fellow at Bayes Business School in London, where I co-edit an academic commodity publication. Before that, I was a scholar at University of Colorado Denver Business School, where there's the J.P. Morgan Center for Commodities. I co-edited a best-selling risk book, Intelligent Commodity Investing. I've done executives. So in a way, again, there's sort of really common principles between all these jobs. So and things that I've done. So I don't really consider, for me, there's a continuity. And so I've also done executive seminars for DePaul University, EDIC Business School, a French institution, in the Chicago Institute of Investments. And so there was a period where I did a lot of lectures for people coming from Chinese financial and regulatory institutions. And so I did the executive seminars for DePaul and Chicago students. And then that ran its course. There are a lot of things I've done, which, there was a huge need, and then that, runs its course, and then it's on to do something else. So my firm also created the Premia Bancorp Index, which is calculated and distributed by S&P Dow Jones Indices. It's a diversified portfolio, equity and bond futures contracts, along with a smart allocation to commodity futures. And again, the common thread amongst all these activities is the application of quantitative and computer science techniques across a range of domains.
So I want to pivot our conversation to the main topic of today, which is risk management for options portfolios. So the first question that I have is, when it comes to options traders managing their portfolios, what are some of the different types of risks that they should be accounting for?
Um, well, in terms of my experience, the way that I'd answer this question would be based on when I supported the software for foreign currency over-the-counter foreign currency options traders. And so they aggregated risks across the portfolio were the Greeks. uh, so evaluating the delta, gamma, theta, vega, and rho. And then since this was a leveraged book, it was with also complex options, whereas you went through certain strikes for currency, then your exposure could very much change. And so it was really important on a real-time basis to evaluate those risks.
And I think when it comes to newer traders, what kind of mistakes do you think they often make when they're assessing risks of their portfolios?
I think it's sort of learning what one's on the fly, what one's risk tolerance is. And so one never wants to be stopped out of a trade because positions were sized too large. So, so mistake, well, it's more of a learning process, is to really know one's own risk tolerance for engaging in any kind of trading, including in options.
And I know when we talk about risk, we always think of like bearish markets or we're thinking the market's not going to turn out too well. But should traders also hedge their strategies when they're making bullish trades in the market?
Well, I mean, it's always judicious to have downside protection. But if one has a portfolio that's not leveraged and one's time horizon is quite large, and if, say it's the stock market, which classically, I mean, there are exceptions historically, but uh, classically the markets do well, um, especially if you also have a fraction of the portfolio in fixed income and even gold. So if one if the market going down isn't going to affect your lifestyle, quality of life, and you have the positions sized according to what you can tolerate, um, then one has to think carefully about buying options, because if one does this systematically, the premiums start to really add up. Although, I mean, there's option strategies for hedging where you think about the how much premium you should be paying, and so classic structure is a cost collar. And I should double check this, but I think classically that's how Mark Cuban was able to keep his fortune in the face of dramatic stock market declines. Was hedging his stock ownership with zero cost collars.
And then do you think these large hedge funds tend to be more risky or are they more risk averse than the average trader?
Um, well, okay. If you're gonna if you're gonna stay in business for longer than a market cycle, uh, you have to be an expert at risk. Uh, so I don't know if I'd say uh, risk averse or risk seeking. Other than like you've clear cut figured out an edge and then you leverage it up and then just risk manage, apply ever more nuanced risk management evaluations against the portfolio. So for this type of business, though, obviously you have to be able to tolerate risk, or else if you can't tolerate risk, then you wouldn't have the mental capacity to keep on doing the strategies across market cycles. So I guess what I'm trying to think is, let's tell her risk averse. I mean, the nature of having like a derivatives fund is that you're an expert on taking on and managing risk. It's like your profession, really.
I hope you learned more about managing risk for options portfolios. I want to say a special thank you to Hilary Till for taking the time to talk with us. Thanks for watching, and I'll see you all in the next video. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.